Well, we are seeing a little bit of buying as we start a new trading week. The TSX and S&P higher in the first few minutes here. For the month overall, it's been a choppier stretch as investors assess the story on interest rates. Recently, they've also been adding earnings to the mix, and you have to consider currency moves as well. Let's talk about all of that with Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeffrey, always great to see you. Let me start with the interest rate story, because one could argue that's one of the reasons why equities started to lose momentum, the idea that the U.S. is pushing back rate cut plans, and we are going to get a Fed decision this week. What's your assessment of what's going on?
Well, the data has just been so strong in the U.S. and inflation's just been so stubborn. We've seen this widening gap between what the Fed is likely to do and what other major central banks are likely to do. In fact, we're now looking at the odds of a June rate cut still over 50% for the Bank of Canada, for the European Central Bank, the Swiss National Bank, but not for the Fed. That's dropped down to below 10% now. And so what we're seeing is this relative economic strength in the U.S. and durability of inflation has really caused this widening gap. Now, that's helped the dollar, but at the same time, and weighed on other currencies like the euro, it's actually lifting the outlook for valuations and PEs and earnings growth overseas. In fact, we've seen that the PE for the MSCI Europe index is actually up a full percentage, not a full percent, one whole point, one PE point this year, and that's helping them to keep pace with the S&P 500, even though the currency's acted as a drag.
So just to better understand the currency story itself, because here in Canada, we spoke to a strategist recently who said, look for Canadian companies that might benefit from a weaker Canadian dollar compared to the U.S. currency, as the U.S. dollar has stayed relatively strong with this continued narrative around rates being higher for longer. Sector-wise, what's kind of the breakdown for you? What sectors maybe benefit? What sectors struggle a little bit more in the United States based on that theme?
So what we've seen is that a stronger dollar tends to act as a boost to commodity exporters and a drag on commodity importers around the world, as crude and other industrial goods are typically quoted in dollars. And that further aids the energy and materials sectors, which have been among our favorites this year. They're actually the best performing S&P 500 sectors over the past 3 months, doing well. Not only are we seeing a return of manufacturing demand as the Global Purchasing Managers Index for manufacturing has picked up, but now this is supported by the currency move as well. So lifting not only volume demand for these commodities, but also their prices.
Okay. On the earnings front, we've got numbers this week from both Apple and Amazon, members of the so-called Magnificent Seven. I think it's fair to say that the tech sector, in terms of the growth in earnings, is a standout sector. But when you look at all sectors and the profit story, what do you see?
You know, the Mag 7's been an absolute standout. For the last 4 quarters, their earnings growth has been positive, while the rest of the market has been negative. And I'm referring to the S&P 500 or even the MSCI World Index of all developed market countries. But by Q4 of this year, earnings for the rest of the companies, the non-Mag 7, are actually expected to grow faster than the growth of the Magnificent Seven. And that brighter outlook by business leaders outside of tech's high flyers may further a shift away from the Mag 7 to other sectors where earnings are recovering. I mentioned energy and materials, but also financials falls into that category as well. Historically, when we've seen the manufacturing sector begin to pick up like this, we tend to see this broadening earnings growth. I think that's a key story coming out of this earnings season, that you don't have to be as selective when you're looking for growth anymore. We're getting a much broader outlook for earnings improvement.
Okay, so on that theme, and when I look at the charts, energy and financials in the United States, they've done relatively well this year versus the S&P 500 itself. Our Canadian financials trailing the TSX a little bit, but energy has done well and materials have definitely done well. Industrials have done well. So here we are talking about a whole number of sectors that are non-tech specific. Based on everything you've said, how would you be thinking about portfolio positioning heading through the year here?
So I think that increasing broadening theme is important. So looking to those sectors, more maybe value-oriented, more manufacturing-focused sectors, I think those are the ones that are going to perform well. Not only than the ones you mentioned, not only because their valuations are in many cases still below average, but they've got that earnings momentum really kicking in. And I think the dollar likely to continue to see dollar strength here in the near term, at least over the next several months, given just the difference in relative global economic growth. And I think that all points in the direction of those sectors continuing to perform. So I think equities still look good. I think there's room for a second wind to the markets here, driven by these broader sectors that haven't really participated much in the last couple of years of this market rally off of the lows we saw back in October of 22. So thinking beyond just the tech sector, I think might be valuable here the remainder of the year.
And as a strategist who looks around the world, are there any geographies in particular that sort of feed into that kind of strategy?
That's a great point. So I like Europe, and one of the reasons is there is so much manufacturing exposure there. We're going to hear from Novo Nordisk this week, not a manufacturing company, but certainly one of the biggest names in Europe. We're going to hear from them. We've got the automakers in Europe reporting this week. So there's a number of potential movers here, catalysts on the upside as we get maybe a brighter outlook from some of those companies, along with the idea that maybe interest rates may be cut here in the near term, improving the overall monetary conditions in addition to the economic backdrop. So all that lining up, I think I like what I see in Europe a bit more than what I'm seeing, at least at the moment, in the US or in Japan.